So we're actually going to go ahead and break down essentially how to find high probability bias in the first place, which is a collection of tools that I have actually given um, on different YouTube videos. I'm basically just going to list them and then go over a few ideas, and then I'm going to go ahead and show you how I'm trading those ranges inside of the bias, if that makes sense. Um, a lot of this as well will be like a Q&A, so like any questions that you have, feel free to sort of put them in the chat, and I will answer them. I'm not going to try not to ramble too much because I know I can talk for a long time. So that's basically the way it's going to get split, but let's actually go through it. So 3-step process, right? First, we always want to know, and this is how I break down things, is where we want to see the daily candle expand to, okay? Whether it's bullish or bearish, or if you have no bias whatsoever. With that, right, and I'm like, this is something that I really emphasize in my trading currently, is where am I looking? Where am I being positioned inside of that daily expansion? Okay, because the best trades, right, if you think about it, if we're bullish, yeah, like if there's a bullish candle, let's say, yeah, like this, right, the best place to enter that bullish candle is when price is looking bearish, essentially when this daily candle would open up and be printing this as like a red candle, okay, which is quite a hard, it is a hard thing to do mentally, but that again is the best place to enter. So then after that, after I've got the bias, typically I'm trying to apply some sort of framework to it, and that's normally, I'd say, it gives me a lot of comfortability. I'm the type of guy, and you don't have to do this, but I'm the type of guy where I like familiarity. And if I know in my head, okay, cool, I've seen London create the low like this hundreds of times and then New York run, for example, it gives me a lot of confidence knowing that, okay, cool, I've seen this hundreds and hundreds of times. I'm just going to apply that same framework and let price ride. You don't actually need to do that. You could just rely on the 1 hour and the 4 hour and go off the closures of the 1 hour and 4 hour. Where I think most people go wrong with the intraday is you're giving yourself such a small room for error. So like, for example, you're trying to break down the low of the day on a 5 minute chart or a 1 minute chart. Like, if you just stick to, honestly, to 1 hour closures and 4 hour closures, and I'm not saying like 1 hour FEGs, 4 hour FEGs, I genuinely mean entering on the close of an hourly candle, you'll probably fix 90% of your issues, right? Number 3 is the documentation and the journaling, right? The bit that no one likes to do, but is the most important part. So daily bias frameworks, obviously I can't go over every single sort of thing that I use in this small video, but I'm going to list them in a second. But pretty much, right, the most important part is building the narrative. So thinking about things from that market maker style theory logic, which again, I'll go into this in a little bit about how I do that. And then also just combining that with maybe statistical edges. So again, I'll show you that in a second. But it's really about like building a picture of like, okay, cool, price has done this. Like, obviously we're all smart money traders here, right? So price has filled this FEG. Where is it likely to go now? Where is it likely to push? One key thing here as well is you don't actually need to look that far back. I used to look back months and months and months and months. Recent price action is all that's really important. Okay. So just to give you an example of some things that I'll use to determine bias, right? We're looking at stuff like power of 3, engulfing candles, swing points, previous candles high, previous candles low, news, no wick, buy programs, sell programs, weekly candle statistics. All of these I have covered in YouTube in separate videos. And obviously if you have like my programs and stuff, then it's all mentioned there, or it is going to be updated, so it does. So just to touch on some of these, right? Just to explain it, right? I'm essentially joining together discretion and statistics a lot of the time. So I would urge you to do this if you haven't already done this, right? Here's an example of a statistical edge that people use, even guys who aren't smart money traders, to actually go ahead and formulate where they think price is going to go. So they use the idea of engulfing candles. Now, if you have any experience with the market, maybe outside of SMT, you probably would have heard of engulfing candles. If not, fine, that's cool. All they are is essentially you have a candle, like a candlestick, and then the following candlestick will sweep out one side of the range and then push higher, closing with a body outside of the high essentially. So in a bullish setting, we sweep the low, sweep the high, and we close bullish pretty much, right? And the same for bearishness, or for the bearish example, we have a candle here, sweep high, sweep low, and we close bearish. Typically it's beneath the open of the prior candle. Okay, now you can actually go ahead, right, over the course, yeah, it's recorded, so you can actually go ahead and go over like you can go and find these in price, right, and test how many of these, okay, lead to a push to this candle's high. So this is again like a statistical edge. So when we get an engulfing candle, based on the numbers, this isn't even a large sample size, right, but this is just over a year. I think it was on the daily candle I did this, maybe the yeah, it must be daily time frame. So I would test, cool, after we got this engulfing pattern, what was the percentage of times that price would go ahead and make or trade to the high of the engulfing candle, so on the third candle. And 25, right, on here led to a push to that previous candle's high, and in the bearish example, the previous candle's low. So for example, let's say, I'll give you an example. If we are trading away from an FEG and we get an engulfing candle outside of it, cool, the narrative is we've rebalanced price, we should now reach for liquidity, for example. And then adding this on, it's like, cool, now I've got an 83% chance in the back of my head saying, yeah, cool, fill the FEG, pushing higher. And I'm just adding on a statistical number to that to even give me even more confidence, because in the examples that I've showed you, right, or sorry, in the examples that I've logged here, probably half of them didn't even have any smart money logic behind them. So the fact that I'm doing this in conjunction with, let's say, FEGs or order blocks or whatever you want to use, it just gives it more confluence, right? Another one that I use quite a lot is the weekly candle statistics. So I logged, I can't even remember how I did this. I think it was like 2 years worth of price action, and essentially out of the results, okay, I just literally logged the high and the low of the weekly candle. And again, you can go and do all this, like all this stuff that I'm showing you. It's not like special to me. You can literally go in your chance to prove this to yourself, and I would urge you to do that as well. But essentially, out of 96 weeks, right, well, it's supposed to be 100, but I've counted a few of them wrong. 77 of them, right, basically created the low on either Monday or Tuesday. So we have an 80% chance that Monday or Tuesday will be the low of the week on a bullish week, and the high of the week on a bearish week. Okay, so in this example, bullish Monday, Tuesday creates the low and pushes higher. If it was a bearish week, it'd be Monday, Tuesday creates the high and pushes lower. Hold on. Okay. Again, on the other flip side, there's an 84% chance that Thursday or Friday will create high of the week. So again, let's say you can even use this on DXY this week, right? I'm not going to go over to the chart, but you can literally go into your charts this week, right, and see we had Monday, Tuesday create low of the week. I can't remember which one. I think it was Monday. Then Wednesday created a high. Thursday created started pushing higher, right? Sorry, I might be referencing EU. So Monday created the high of the week. Price went lower. Wednesday was the current high. Thursday went higher, and then Friday, right, didn't sweep anything, just rocketed down. And we could have used this statistic to help us figure out, okay, cool, you know what? Wednesday's low of the week. We haven't taken out any major liquidity yet. So is it viable for us to assume that Friday could go ahead and create the low? Well, we know, again, combining the discretion of, fine, there's no major target taken, plus the fact that we know there's an 84% chance that Thursday or Friday should be low of the week, we can confidently trade a short, right, or a buy on EU, short on DXY. So now, more of the discretion part is the buy and sell programs. You guys who have watched me for some time will be familiar with the way I use this, but essentially, right, when we're bullish, you want to look for bullish arrays to hold, right? And when I say this, try and apply this on a more of like a daily H4, H1 time frame. I know people like to get wrapped up in the lower time frames with this, but like if you literally scale out, like even this is like a something that I wish someone told me, right, is if you actually just scale it out a little bit, you will make your job so much easier. A lot of the things that you're doing and the confusion of like, oh, here's 15-minute order flow, and then there's hourly order flow, and then there's like daily order flow, and there's so many things to take in. If you just scale out a little bit, it will be a lot easier to understand, to deal with the multiple time frames. Like I said, right, if for example we're looking to be bullish, right, you're going to be looking to enter when the candle's bearish. A sort of neat little trick that you can do, especially with sort of finding the low of the daily candle, is just looking for a simple CSD or formation of a bullish array when, or on the hourly, when we're looking to be bullish, right? So in the buy program, you want to be expecting bullish arrays to hold, so like the order blocks, the FVGs, but more importantly, you want the bearish arrays to be disrespected and used on the other side. So if you look at DXY this week, we reacted off a daily FVG, but also there was an inversion gap there from a bearish from a bearish FVG that flipped. And there was another one. I think it was gold. There was an FVG there as well, to be fair. But in terms of buy programs, right, this is another important thing, is when we are bullish, and this is something that Jade Cap actually mentioned as a guy that I follow. He mentioned that when you are bullish, you actually want to ignore all the bearish arrays. So like you don't actually care. You're not worried about that, about price reacting off of them. You actually want to completely ignore them if you believe price is predisposed to go higher. Okay. The other key thing with buy and sell programs is any run beneath an old low. I haven't written it here, but any run beneath an old low should act as a liquidity sweep to go higher, and that can be a good point of entry a lot of the time. Okay, and then obviously vice versa for the sell programs. Again, as well, in terms of what we're actually targeting, it's always going to be FVGs and old highs, right? Which again, most people know, but it's applying this on the right in the right areas. So, for example, you might look at price and you might go, okay, you know what? I know when we're bullish, price is like respecting all the bullish levels, and it makes sense. But then maybe your bias isn't good, and you don't know when to apply the buy program, for example. So then you would need to say, okay, cool, I need to fix my bias. I need to make sure that I'm actually getting behind bullish days. Yeah. So a lot of this is another key thing as well. When we run beneath old lows to go higher, a lot of the time, and I do this as well. Sometimes you end up buckling on your bias. You end up thinking, oh, bias might flip, etc. That's probably the worst thing that you can do, right? If you believe that the bias is up on the set day, 9 times out of 10, you should stick with it and just roll with it until the end of the day. Okay, even if you do get it wrong. That's my piece of advice in terms of not taking like a million losses in the day, flipping bullish, flipping bearish, and then just getting caught up in crap. Another really important thing is, or one thing that you can use is just FVG fills, right? It sounds really basic, but you'd be surprised the amount of people that don't even use this idea, right? So for example, let's say we're bullish and we go ahead, we filled an FVG and we've printed this candle here like this, sort of like a pin bar. We can expect that following daily candle to actually push up and go to the liquidity. Reason being is because we've done everything that we need to do inside of this level. Again, we can anticipate the buy program, for example, here. And also, right, this is something that I've been doing a lot recently, is let's say this is an hourly time frame. You can literally enter off of the fact that this candle closed bullish and there's no reason for us to do anything, or to go lower past this point, or at least let's say invalidate this low. All right, fine, we might go a little bit lower and then go higher, that's fine, but in terms of this low, in terms of actually filling this area, we have no reason to go any lower. Okay, so like I said, a lot of your lower time frame issues can be fixed with hourly closures, for example. You can even get to the point where you're executing on these hourly FVGs as well, right? So let's say you enter on the hourly FVG, stop here. After we get the closure, you can then scale in. You can add to the position. You can cut this position and add to it pretty much, right? But yeah, sorry, I'm just trying to there's a lot of like overlap here. Like for example, FVG fills. Yes, we're talking about buys, but there's so many ways you can implement these sort of things. And there you go, right? Candle pushes higher. So like I said, right, I typically am mixing statistics, right? If I go back to this point, with discretion. So for example, with the engulfing candles, I'm like, cool, we got that engulfing candle. Now I know we're likely, it's 83% chance that we're gonna go higher. Okay. I might mix that in with the weekly candle statistics, and then I might say, okay, cool, order flow wise, we're respecting bullish arrays and we're disrespecting bearish arrays. And then I might use the news. And this is what I mean by it. You're going to build a narrative. It can feel a bit overwhelming, but again, you don't need to use everything on this list. You might say to me, you know what, I like the engulfing part. I'd say power free is like a must. And you might say, okay, cool, the news is really important. And then I mix in the buy and sell programs. And that's enough. Like, you don't need everything on this list. It's just an example of different tools that you can use. And the cool thing about it is when you do test them, you realize that the edge is there, right? You know, you see a lot of people online, they talk about, oh, do you really have an edge? It's like, you can go into the chart, half of these are already going to give you an edge. Statistically, if you check the, for example, even swing points, right? I know I haven't covered it too much. It's just a free candle pattern. If you test, does the next candle push higher? Like, you've already got an edge there, okay? So there's so many different ways that you can implement these things. Um, so power of three is basically just if you were expecting a bullish candle, then initially you're expecting it to run lower before going higher, essentially, and vice versa. If you're bearish, you're expecting the candle to run higher before going lower. So once you've got the bias nailed down, okay, and to be honest, the bias part is like the heavy lifting. Yeah, I have preached this for a while now, but at most 9 times out of 10, I do the bias the night before, and I just stick to the bias. I won't shift on the bias. So if I know where the daily candle's going the night before, then waking up, I'm just looking to trade in one direction, pretty much. And the way I like to frame those trades or those expansions is using cycles, right? Daily cycles. Now the trade doesn't have to fit in the cycle. Prior to I'd say even a few months ago, I would 100% stick to very, very, very intricate and detailed cycles. But at this point, just using H1 and H4 closures, I feel a lot more relaxed in the sense of just adapting with price. But I would say daily cycles in of itself is what really helped me bridge initially the framework between like getting the bias and then actually being able to trade the expansion. And if you do like the lower time frames, then the daily cycles do offer you some nice lower time frame style stuff if you want it. Okay, so when we think about trading the intraday expansions, okay, you want to be thinking about which traders are trapped and who's in profit, right, in terms of a session basis, right? So for example, this week Asia ran a lot before we got a move, and that would put me off trading the following session because in my head we're thinking, cool, Asia's just ran, that means all these Asia guys are in profit. It would then I would then expect price to slow down or consolidate, and then maybe to take London, for example, in New York, and then push, because then I actually have liquidity behind my move. This is why, for example, sweep of Asia and then a push is really solid, because you're actually trapping a set of traders and then the market is reversing. So we understand again that traders stops will be resting under previous day's low, previous day's high, and session liquidity. Okay, and that's basically how all the daily cycles are crafted and the basis of why they look like the way they do, pretty much. Okay, and again, we're going to go into that in a second. And I already said this before, but honestly, this point alone, like really, really, really put things into perspective for me. But you really just want to think about where are you positioned in that daily candle. So if you're looking to be bullish, right, and you could probably do this, right? You could probably go over your last 10 trades, and let's say you had a bullish bias, right? If you're entering here, okay, and I mean like you're trying to buy here, you'll notice the probabilities of you squeezing out this range and just timing the top is so less probable than trying to get in anywhere around here and then maybe cutting your position here. right? And you might even notice that half your losses are you just trying to trade a really overextended daily range. Okay, so I put it into very simple terms, right? I pretty much just say there's two different trades that you can take inside of the daily expansion. You're either capturing, I don't know what that is. There we go. You're either trying to capture the manipulation, so like the top of the range, or you're capturing the continuation, right? Now, I'm not saying you have to sell into the move higher. I'm not saying that, like, I just haven't drawn like the CSD or whatever here. But the first trade is typically you trying to get in at the top of the candle, which is probably the best place, in my opinion, to get in. So, I mean, both have their advantages and disadvantages. But if you're really, really confident in a bias, then the best place to enter is going to be in that manipulation pot, because you're going to be able to capture majority of this range. And the beauty of it is that you don't need to even hold for the entire move. Like, you might get out in and around this level, and it's like you've caught majority of the range. Like, well done, that's fine. After that, right, after we get like a first sort of leg down, you then have the continuation entry. Again, I'm not saying one is better than the other. It depends how your, sort of, guess, your conviction in the bias itself. If it's like mega like, yes, you're like 1,000% sure that the bias is going to play, then the manipulation one is probably the best. The continuation one is just another entry that you can get in, maybe if you've missed this one. Okay, so the first one, right? So the first thing I'm going to break down is the cycles that allude to the manipulation. This isn't every single cycle, but this is quite a few of them. So the first one can be London protraction. So this is basically just Asia being swept out and then price pushing higher. And again, you can reflect this on a bearish candle as well. And again, thinking about it, where are we entering when we do this? Well, we're entering in and around the low of the candle, right? Why does this work? Why does this make sense? Because traders, right, Asia guys are being trapped, right? So any guys trying to sell the breakout of this low are getting trapped, and then price is running forward. Let's imagine this is an hourly time frame, right? And I know it's not always going to look this clean, but it's just an example. You might notice the sweep down, and then let's say this hourly closure is this engulfing candle, swept the low, swept the high, body close above the open. You know already there's a 83% chance that we're going to run this high. You know that we're very likely to run Asia high. And if you know this cycle in depth, you'll know what time we typically going to run to, right? Which is close to the end of the session. So let's say this hourly candle closes, you can just execute on this hourly candle, maybe stop at the liquidity and just ride the move out. And the beauty of playing this is, you know as well, right, that this is the manipulation move. Typically, this is followed by a continuation move afterwards as well. Okay, so this is why I'm always saying the bias is the heavy lifting. This is just applying like a sweep of a session and then some sort of closure to solidify the fact that the low of the day or the high of the day is in. And that's one of the biggest questions I'm always asking myself is, if I am bullish, do I think the low of the day is in? If I do think the low of the day is in, then I'm just looking to get behind the move. This is a New York reversal. This is a sweep of London. Could be a sweep of Asia as well, and then a move higher. The reason it's called reversal is just because it runs out London and Asia. When I say reversal, I'm not saying like, oh, I was bullish or biased and then now I'm bearish biased, if that makes sense. Like, I would go into this day thinking, yeah, cool, this should be a bearish day, if that makes sense. Yeah. And again, you could apply the hourly closures to this. Maybe you notice we formed this swing point, right? I know I didn't really cover swing points too much, but let's say 1, 2, 3 swing point formed. Maybe you execute on this candle, right? Let's say this is again an hourly time frame. Yeah, cool. There might be a 50-minute model in there and stuff. That's fine. But I'm just showing you, like, you don't necessarily even need to go and work these lower time frames all the time. Okay. Next one is Asia low of day. So this is where the low is actually made during Asia, right? And typically there's going to be a sweep. The best Asia low of day sweep previous day's low or high, and then push higher. Again, this is considering that we were predisposed to go higher in the first place. Price typically sweeps and then goes higher. Sometimes Asia high of days, low of days are just going to be a sweep of just like a singular high, like a hourly hourly high or low. But typically they will be sorry, I got distracted there. They will be best suited if previous day's low or high has been taken. This one sort of goes against what I mentioned at the start about the liquidity being based on session liquidity or previous daily high or daily low. So again, if you didn't want to implement this one, then that is cool. So moving on now, right? We have the continuation cycles. So let's say we've had Asia, London's impulsed, and the key thing with the continuation cycles is that we aren't overextended. And the way you can figure that out is two ways. You can either use average daily range, which again, I'm trying to be quick, so I won't be able to talk about that. Or if we haven't taken out a target. So for example, if London went ahead and formed equal highs, then it makes sense to anticipate a continuation in New York. Yeah. So again, you could execute off the hourly. You could literally just say OT entry or hourly FEG and a wide stop. As soon as we formed a swing point, you're like, oh cool, I want to scale in now and I want to move my SR up to here, enter here, and then allow price to push higher. So it's nice with the continuation entry because you sort of have the low of day in and you're just trying to catch sort of the rest of the range. Okay, technically speaking, you could be in both, right? So sometimes, okay, with the continuation cycles, you're going to have, it's going to be a little bit more messy. So these ones assume that Asia had created the high of the day, London pushes higher. So let's say, for example, on those days where Asia has either ran or Asia has created high of the day, sometimes London will be a good move lower. Like let's say it was an Asia lower day and you played London, which is fine. But then you're thinking to yourself, cool, well, all of these guys in Asia and all of these guys in London are in profit, technically speaking. So sometimes, and again, this is under the idea that we aren't overextended, etc., etc. Price can go ahead, retrace, sweep out London, either in New York or in between sessions, and then run lower. Okay, and again, it's just the idea that we've missed that manipulation entry, right? So instead of London being that low of the day and we're pushing higher, it's basically just Asia being the high of the day. We're pushing lower and we need some sort of liquidity for us to continue to the downside, right? The only difference again with these two is typically this is just a fair value retracement to go higher. And so the continuation entries don't always have that liquidity behind them. And that's the beauty of the manipulation trades. So again, these are just versions of cycles. This is still an NY reversal cycle, and this is still an early NY reversal cycle, but it's just put in a continuation format. Okay. So with manipulation ideas, your focus is, have we put in the high or the low of the day, right? Like I mentioned prior. So that's literally all I'm thinking at this point. Like, cool, I'm looking for this day to be bearish. Do I think the high is in? Like, has the high formed? How am I going to determine that? We're going to use the news. We're going to use the hourly closures, the engulfings away, the sweeps of liquidity, the retrace into an FVG, right? You're not always going to get it right. That's fine. But do we believe, okay, that the high of the day is in? If you're trading indices, you know that majority of the time, high of day is going to come in that first hour of AM session between 2:30 and 3:30, and that's just statistics as well. So again, with the manipulation, that's the most important part, because once you know the high of day is in, then all your job is just to get on side with that range. Okay, you don't have to be really fancy with it with a tiny SL. You can literally just say, cool, I think the high of day is in. I want to now be short and I want to have my stop in a reasonable place. So after that, we then have the continuation, and the biggest question is, are we overextended? Okay, i.e., have we ran too much in this first leg lower for us to even have the ability to catch the extension or the further extension lower? So again, you can use ADR, you can use the fact that we've swept we haven't swept any major targets. We haven't hit like a major daily FEG or a weekly low or anything like that. Okay, so this, I know you can't read any of this, but the point that you want to get to is the point where you can literally go ahead and map out your entire process like this. So for example, at the start, it will say like, I can't remember what was written here, but basically each step would be like a yes or no answer. So I might ask myself, can I determine the bias? Yes. Then is the higher day, lower day in? Yes. Take trade, for example, right? And you want to get it that systematic so that when you're going into the charts, you don't really need to think too much in the sense of like, what is my process and what is my plan. It doesn't mean you're going to be prepared for absolutely everything, but you want to be prepared for most things that can happen. This is just the whole thing summed up in one picture. Here, for example, we moved lower, we swept liquidity, we pushed higher, we disrespected this bearish array, and we're anticipating the next bullish candle to sweep for equal highs plus some fair value. And this is what the daily cycle looked like. It's just a hypothetical thing I drew out just to show you the connection between the two ideas of building the higher time framework for the daily bias and then applying a framework, a daily cycle. So lastly, the documentation and the journaling. Let me just, okay, this isn't the last slide. I always do this in 3 steps: the pre-market game plan, the intra-session, and the post-session. And simply put, you want to do the night before where you think price is going to go, and then intra-session you want to talk about the updates, what are the hourly closures doing, where do you think price is going to go, and then you want to follow up with what did you get right, what did you get wrong, what did you take. And honestly, like, I know this is like crazy overlooked, but even this one thing will enable you to highlight probably 90% of the things that you're doing wrong. Yeah. So I'm going to end the presentation part there. If you do have any questions, then feel free to put them in the chat. I haven't actually left that much for questions, but if there are like extended questions, we can just go into the Discord live and answer them.